In today's video, I'm going to explain everything that you need to know about dividend yields and why this number catches many new investors off guard. Okay, so in short, basically a dividend yield measures how much cash return you're going to be getting from owning a stock based on its current price, and it's going to be shown as a percentage. To work out a dividend yield, it's really simple. All you need to do is just take the annual dividend per share announced by the company, divide it by the current share price, and express it as a percentage. Let's explain this in a quick example. So let's say a company, and for the example purposes, let's call it Bill's Bakery, pays $2 per share each year in dividends, and today its share price is exactly $50. To work out the dividend yield, all we need to do is take $2, divide it by 50, and this is going to leave you 0.04, meaning that the dividend yield is going to be 4%. Now, the key thing to remember here is that this number and percentage will always fluctuate almost every single day, just pretty much like how a stock price goes up and down as well. And it's actually this bit right here that actually catches a lot of new investors off guard, myself included. Pretty much when I first started, I used to think that dividend yield was almost like a rock solid promise. I used to think, oh right, a 6% yield means that I'm going to make 6% in terms of dividends every single year and it's going to be easy money. But realistically, the truth is it doesn't work like that at all. And if you don't understand how it really works, you might buy a stock for the wrong reasons and actually end up losing out. To explain this further, let's go back to Bill's Bakery and let's say you invested £1,000 into that stock. If the stock stays $50 all year and they don't announce any new increase or decrease to their dividend payout per share, you'd make $40 in dividend payments. That's the 4% that we just mentioned. But let's say in another example, you invested $1,000 again, but let's say that this time the stock price rises to $100 a share during the year and the dividend payout once again stays the same. You'd still get $40 because you own 20 shares, each paying $2 a share in dividends. But when you analyze the stock, the dividend yield is now going to show 2% instead of 4%. This means if you're using yield as a way of measuring the dividend, this is going to look half as attractive, but in reality, it's actually the same. So with that said, be very careful when you see a stock with a high yield as well, because sometimes this could simply mean that the stock price has recently dropped and no changes to the dividend has actually taken place. Instead, what you should do is follow these simple checks which I use when I analyze a dividend stock. Number one, check the payout ratio. Is the company paying out more in dividends than it actually earns? If so, the dividend might be a little bit shaky. Number two, look at the dividend history. Have they paid dividends consistently for the last 5, 10, or even 20 years? When you have a company that pays consistent dividends, this means you know what you're going to be getting, and this is going to build trust. And number three, check the industry stability. For example, some businesses are more recession-proof than others, things such as like utilities and consumer staples. These are going to offer much more dependable dividends than maybe, let's say, a trendy tech startup. It's really important to do your research with dividend stocks, maybe even more than an ordinary stock, because if you do skip this, you might chase a yield that looks amazing, but is about to disappear, and that stings way more than missing out on a hot stock. Now, if you wanted to know where to go to find out a stock's dividend yield, just head to a website like Yahoo Finance, and what you'll do is find it on the stock summary page. But with that said, just remember, dividend yield isn't a forever promise. It's simply just a snapshot in time telling you the return you'd get right now at the current price and payout. Tomorrow, it could be higher, lower, or it could even be gone altogether. The smartest way to use yield is to compare its potential returns between companies, use it alongside things such as payout ratio and history to spot red flags, and you can also use it to estimate your income, but never assume it's completely locked in. I hope this video helped. Leave a like if it did, and if you did have any questions, drop them in the comments section down below, and I will see you in the next one.